Hey there, welcome to the last session of our course. And in this video, we are going to understand three things. First is the golden rules of trading. Second is how to be consistent at trading. And the third is how to control your emotions. So let's get started with the seven golden rules of trading. Now, again, I want your full attention in this video because this video is going to be very important, especially if you are focusing on trading and if you are looking at trading from a professional career point of view. So, what are those golden rules of trading? Let's start one by one. First thing, win big, lose small. So, this is probably the most important thing in trading, what professionals do and retailers don't. So, what do I mean by win big, lose small? Whenever you take a trade, let's say it starts to go against you, what most people do is they keep hoping that this particular trade will reverse and give me profits. Despite the stop loss is out, despite their stop loss is taken, despite they know that this might continue to go down, they just keep hoping that this particular trade will reverse and give me profits. Don't do that. Never ever do that. Never hope trade. Never do a hope trade. Win big. And what they do is exactly opposite of what professionals do, because when a professional is on the losing side, he will just cut out of the trade with whatever small loss he's having and then focus on the next trade where he think an opportunity is. What retailers do, what we people do is we stick to that particular trade emotionally and mentally. We are not ready to give out on that small loss just because we think it might reverse and give us profit. Never happens. Have you ever experienced it might happen once in 100,000 trades, but usually that never happens. Whatever is going down basically continues to go down. Whatever is going up continues to go up. Now, this is the first problem, that we do not lose small as a retailers, we lose big. And because we lose big, it creates a emotional down spike within us. The account is losing, that is another thing, but we are literally pulling ourselves into a black hole. Our confidence starts to lose, and then when we approach the next trade, we are like, oh no, let me take the profits of this trade, whatever it is giving right now, otherwise this might also turn into a loser, and this cycle, this vicious cycle continues. So whenever you are winning big, you have to imagine stock market as a ball in a space of vacuum, in a vacuum. So what happens in vacuum where there is no space? Like in universe, there's no space. What happens in vacuum? If you throw a ball towards something and there is no space, that literally means there is no friction. So that ball is going to go in that particular direction, in the direction you threw it, isn't it? So similar, markets are very similar to this particular concept. Let's understand it in a better way. So like this is the ball and this whole thing is a space. Okay, and if you throw the ball in this direction, this ball is not going to come like this because there is no friction, there's no opposition. So this ball after some time will be here, after some time will be here. So you have to understand that thing, that trading works or the markets work in a similar fashion. So something that is going up has very higher chance of going up, and something that is coming down has a greater chance of continuing to going in that downside direction. So you have to understand that markets are not here to just listen to what we think or what our analyzation is. It will do what it wants to, and we just have to follow it. So whenever a market is going up, we think that, hey, let me book my 500 rupees profit, 1000 rupees profit, because it might give me loss, it might reverse back down, and then this 500 will also be gone. No, what happens is when you usually exit here, it comes down and then goes back up again. This 500 would have been 5000 after 1 hour. And then you start to regret and you do the same mistake over and over again. You do not learn. So you have to understand that markets basically behave in a directional point of view. So what is continuing to going up, it will go up. What is coming down will continue to go down. So never hope trade and never exit in small profit. So whenever the market is going against you, Whatever the small loss is, whatever the small loss is, just accept that loss and get out of the trade. The thing is, you have to be probabilistic in your mindset that whenever you punch a trade, you have to accept the fact that there are two possibilities on this particular trade. One is I am going to make money on this trade. Second is I am going to lose money on this trade. And then, if the first possibility comes in, if you are winning, then you have to make sure that you have to win this one big. Just because the market is going up and it starts to come down, you do not have to feel that this particular profit position is going to just take away your profits, because that is not going to happen. This is a retracement move. Remember we talked about those retracements. So if you're long over here just because it broke out, just have some patience. Have some patience. You have your stop loss over here, right? So you have to trust that stop loss, because market is going to play with your emotions. It is going to go up and down. So it makes sure people like you are out of the market and you do not make money. So it is going to play with your emotions. And once you exit, it is going to make sure that you regret your decision, because you exit somewhere over here thinking that, hey, let me exit before it goes way too deep, and then it goes up. So this is what happens. And if this is when you are on the winning side, if the trade is going in your favor. Second, you're going to lose money on this trade. So you have to accept the fact that the moment you punch the trade, you're going to either win or lose. So we saw the winning possibility. What happens when you win? Second is you're going to lose. There are only two ways. You're either going to win or lose. So if you're going to lose, you're losing in the markets. If the markets are going against you, if the trade that you have punched is invalid, the moment it gets invalid, you have to get out. Say the markets are coming down, and on this breakdown, you sold over here, and then you had this as stop loss. So if the market reverses back and goes above this stop loss, it's your duty to cut out your losses short and get out over here. Because what happens if you don't get out, it might just blast against you. And this, when this kind of move happens, it is extremely difficult emotionally to exit your losses, because at this point your loss is, let's say, 1,000 rupees. But at this point, your loss is going to be 8,000, 9,000, 6,000, or anything. And that heavy loss is very difficult to take. So exit at the loss which you can take. So this is very important. And let's now understand the second rule of trading. All right. Patience is the second name for trading. Now, we discussed this in previous sessions as well, that there are two types of patience. The first type of patience is basically before you punch a trade, you have to be patient. You have to show patience to the market to actually give you a good trade. Because if you are randomly punching trades, then you are going to lose money. So you know you have a setup, you know you have a trading system, you know you have a strategy. And until then, until the market tells you to trade, or until the market shows a trade that is complying with that particular strategy or setup, you have to stay quiet. You have to stay silent. You have to sit on the sidelines. You have to show patience to the market. And once you get in that trade, once the market tells you to trade, then at that point you cannot back down. At that point you cannot say, hey, I am afraid. You cannot say, hey, I don't think this is going to work. You cannot say all those things, because the setup is there. The market is telling you to trade. If you do not punch that trade, it is going to go in your favor, and then 10 minutes later you are going to regret it. So you have to show patience before the market tells you to trade, and you have to show patience after the market has told you to trade. Because once you enter that trade, you have to show your patience. You have to give the time to the market to work. You have to give the time to that particular trade to work it out. You cannot just say, hey, I have entered into this particular trade now. Now, hey, market, please give me the move. It does not work like that. You have to show patience until the real move comes. So patience is very important. Patience is the second name for trading. What is the third rule? If you cannot follow your own rules, don't expect the market to reward you. Now, this is very important. This is about discipline. We all create rules and we all do not follow them. Most of us do not follow those rules, and that is why most of the people are not able to make money in markets. Because if you cannot show discipline, patience is one thing, discipline is another. If you made a rule that, hey, I am going to exit whenever I see 1,000 rupees loss on my particular any particular position, this is a rule that you made yourself. And if you're not following that rule, if the market is at minus 1,000 and if you're not exiting that position, market is going to give you pain. And it is not market who is giving you pain. In fact, it is you yourself who are giving you yourself the pain, because you made a rule that I am going to exit no matter what whenever I see minus 1,000 on my position. Now here you have minus 1,000 on your position, and now you are busy hoping that this minus 1,000 turns out to plus 1,000 or at least zero, so I can get out to cost, and I will not have to bear the pain or bear the loss. Is this how the markets work? No, it doesn't. You make a rule that I am not going to take profits below 3,000. Whenever I am into a winning trade, I will win big. I will win 3,000, 4,000 rupees. I will win three times or four times of what I am risking. And as soon as the trade starts to go in your favor, you are like, after 500 rupees it is giving you, in 500, 600 rupees profits, you are like, no, let me exit before this turns out to be a loser. Is this how market operates? Is this how you follow your rules? No. So if you do not follow your own rules, do not expect market to reward you. You have to understand that. You have to follow your own rules. It is all up to you. Fourth, change sides if the market tells you to do so. What does that mean? We all have our biases in our mind. We all have that particular thing, that analysis that we did last night, that this particular stock is going to go this way. This particular stock is going to go that way. What happens if that particular stock or asset is not going the way we thought? We keep holding on to that trade. We keep holding on to that trade with our ego, with our analysis that, hey, I analyzed this is going to happen, so it must happen. Don't do that. Market is not obliged to follow you or your analysis. It will do whatever it want. If you are in its way, then you are going to get slashed. So don't do that. Change the sides if the market is telling you to do so. If the market is telling you, hey, I am going to go up, and if you are short on the markets, cut those shorts and go long. If the market is telling you, hey, I am going to go down, if the technical chart patterns that are occurring right now in front of your screen are telling you that it is going to go down and you are long on the markets, cut the crap out, get out of those longs and short the market. Do what the market is telling you to do. Do not tell the market that you should be doing this. This is very, very important. Let's move on to the next. Fifth rule: trade aggressively only when you're trading well and modestly when you're not. So, what does this mean? What happens is that usually when we take a trade and that trade does not go in our favor, market does not reward us for that particular trade. So, what we usually do is, on the next trade, we even double our positions. On the next trade, we double our positions and think that we will earn double of what I lost. This is the usual mentality of retailers. You shouldn't be doing this because you are not trading right, you are not trading well. And when you are not trading well, if you double down on your position, what is going to happen? You're going to lose. And on the contrary, whenever you are trading right, whenever you are doing good in markets, you have to uh, keep doubling your not doubling exactly, but you have to keep adding to your positions and then take advantage of that particular zone that you are in. When you are trading right, then you are fine if you trade aggressively. When you're not trading right, when you're not doing good in the markets, do not double down on your positions and think that I will recover my money plus I will make some more money if I go right on this trade. So you have to understand that you cannot do that. Don't do aggressive trading when you are not trading well. Trade modestly. If you're taking 100 quantities and going wrong on it, on the next trade you shouldn't be taking 200, you should be taking 50 quantities. That is how it should work. So understand this thing. 6. Understand that your business isn't trading, it is to find right trades. People think intraday trading is all about trading. It is all about trading the markets all day long continuously. It is not about that. It is to find the right trades that comply with your setup. It is again the second rule we saw. patience is the second name for trading. So you have to sit tight and sit right in front of your computer until that setup occurs. The setup is not occurring in front of you, you do not have to trade it. You have a setup, you know your strategy, you have it. If it's not occurring, you do not have to take it. No matter how the market is going, it's going 2% up, 3% up, 20% up, no matter what. If your setup is not telling you to trade, do not trade. Your business is not trading. It is to find right trades. Market will not reward you for doing 10 trades or 20 trades in a day. It will reward you for doing the right trades. Even if you do one right trade every 2 days, it will still reward you. So do the right trades. And seventh is keep a trading journal. Now, this is where most people know what to do, but they still don't know. Most of you might have heard this thing, keep a trading journal, keep a trading journal. But tell me, are you keeping it? Are you writing stuff down? Are you keeping a note of what you're going wrong? Are you keeping a note of your mistakes? No. So this is where we face our problems because we do not remember what we did the mistake last time because we do not write down. We forget about it. And when we forget about it, we are bound to repeat that mistake again. What this trading journal does is it remembers what mistakes we did and then it tells us to not repeat those mistakes because until and unless you keep repeating those mistakes, it's going to be very difficult. Unless you learn from those mistakes, it's going to be very difficult. So the first thing is you have to understand you cannot keep repeating those mistakes over and over again. So whenever you lose, keep a journal, keep a note of it. Whenever you win, keep a note of it. Why did you win? What was the right thing that you did in this particular trade? Understand those things and keep a trading journal. So let's now move to understand next point, how to be consistent in trading. So when we talk about trading consistency, there are a couple of things that we need to understand. What exactly is consistency? What do you think is consistent? Being consistent means? Well, most people think that trading consistency basically means making the same amount of money every single day, every single month. That is absolutely not true. Most people have this perception that hey, if I have 1 lakh rupees capital, even if I make 500 rupees every day and there are 22 trading days, so I will make 11,000 rupees per month. That is 11% of my capital and I will keep earning 10 11,000 per month and that is enough for me. Trust me guys, this is not how market operates. This is not how it works. If it was that easy, everyone would have just quit their jobs and done this market thing. Consistency does not mean earning a same amount of uh, thing every day and every month. It does not work that way. Some people have this thing in their mind that if I make 1000 rupees today, I will be done for the day. So today's goal is 1000 or today's goal is 500 rupees or today's goal is 5000 rupees or whatever. According to their capital, they have these goals in their mind, preset goals in their minds. What happens is these people have their goals on the positive side only. Like if they make 1000, they will stop for the day. But they do not have those goals on the negative side. They never make these goals that, hey, if I go minus 1000 for the day, I will stop trading. It is exactly what needs to be done. You do not have to keep a upper limit to the market because there is no potential to what you can earn. But you need to keep a downside limit to yourself that, hey, if I go 500 rupees negative today, I will stop for the day. If I go 1000 rupees negative today, I will stop for the day. If I go 5000 rupees negative today, I will stop for the day. You have to keep those limited downside options open for you because upside potential is immense. It is literally the sky is the limit in the markets. And when you're doing good, when you're trading fine, when the market is rewarding you, why would you want to limit yourself? You would want to limit yourself when you're trading bad, na? When you're not doing well in the markets, that is when you have to limit yourself. So people do exactly opposite. They have these upper limits that if I make 1000 rupees today, I am done for the day. But what happens if that if on that particular day they start losing? They do not have plans for that. Minus 5000, that minus 500, they are fine. Okay, it is part of the game, they say. Minus 1000, they are fine. It is part of the game. It is part of the game के नीचे They keep riding those losses until they are completely wiped off. So what people do is they have these goals in their mind that आज का 500 रुपया बन गया, if today 500 rupees is also done, I am fine. अगर आज का 1000 रुपया बन गया, मेरा हो गया. You have to do exactly opposite of it. You have to keep your downside limit for yourself and not a upside limit, because when will the market reward you? The market will reward you only when you're doing well. So if you're doing well, ask this question to yourself: if you're doing well in markets, is there any need to limit yourself? No. When do you need to limit yourself? Not only in trading, in every in every aspect of life. In in no matter what you choose, it is going to be the same perspective all over everything. Just whenever you're doing bad, whenever you're not doing good, you have to limit yourself. When you're doing good, why would you want to limit yourself? So ask this question to yourself, that am I going to make, or is my goal to make 500 rupees per day every day, or is my goal to make 1000 rupees per day every day? No, that is not how it works. Keep the upside open and keep the downside limited. So instead of saying that, hey, I need to be consistent, I need to be making 500 rupees every day, keep this thing as, hey, I need to be consistent with my small losses. So I will take a hit of maximum 500 for the day. If I am minus 500, I am out. And I will keep riding my profits if it goes my way. Make your goals like this. Do not limit your potential, because sky is the limit. So consistency does not mean making some random amount of money every day. It actually means to keep your losses small when you are losing and win big. And if you do this over time, this again is the golden rule of trading, golden rule number one. If you keep doing the only thing, this losing small and winning big, if you keep doing this thing over time, trust me, you're going to make a lot of money in the markets. A lot of it. So don't confuse consistency with making some money every day, every month, every year. That is not how it works. Just have that consistent thought in your mind. Trading consistency basically means having consistent thoughts and clear vision about market, that what are you going to do? No matter the market, no matter the market conditions, because we do not know what the market has in the box for us today. All we know is that, okay, no matter what happens, I'm going to lose small. No matter what happens, if I win, I'm going to win big. If you keep a clear vision, if you keep a clear thought process about the markets in your mind, a consistent, clear thought process, then that is going to reward you very, very in a bigger way in the long term. So trading consistency is not about making money over time. It is about having those clear thought processes and clear vision about what you are going to do with the markets. So you have to keep your losses small, you have to keep your profits big, you have to follow your own rules, you have to follow your discipline, you have to be patient when the market is telling you to be. These are all the things that you need to be consistent with, and not the money. Trust me, if you are here to make money, you will never make it. You have to ignore money to make money in the markets. That is how stuff works over here. If you are ignoring money, you will make money. If you are following the money, you will never make money. So rather than money, focus on all these things: patience, discipline, your rules, your thinking process, and then the market will reward you for sure. So consistency is, again, telling you, consistency is not about money. It is about a clear thought process or a clear vision about markets, that this is what I'm going to do, or this is what I'm going to follow. How to control your emotions. Now, this is a very important part of trading, because how to control. Because what happens is, we all are emotional beings. We all fear, we all have panic, we all have anxiety within us, we all have that insane greed within us. And that is what drives market. Basically, market is made up of our emotions. Stock market is nothing but a mass emotion ball coming together. It's just emotions of all the people around the world coming together. And what are those charts that we see? The charts are nothing but emotional play. Those charts, those candles that we see, what are that technical analysis things, those chart patterns and everything? It is nothing but the emotions of people that are into play. So you have to control your emotions, but what is the way to do it? The number one way to control your emotion is to keep your position size according to your capital. If you are risking more than you can afford to lose, then you are going to have those emotions within you. Because what happens is, let's say if your capital is 1 lakh, you should be technically risking not more than 1000. But if you are risking 10,000, let's say if you are risking 10,000. So it has downsides on the both sides. Like if it is going against you, you're going to fear a lot that, hey, this 10,000 rupees is going to go. You're going to have that fear and anxiety and panic. And when it's going in your favor on a capital of 1 lakh, when you are risking 10,000 on a trade, when it goes in your favor, you're going to have greed because it is not going to make you small money. It is going to make you big money according to your capital. You are risked 10 times of what you should have risked. And then when it starts to go in your favor, you are going to have that greed also. So if 10,000 goes to 20,000, you're like, no, I'm not cutting off now. Shirish told me to ride those profits, so I'm going to wait until this 10,000 becomes 30,000 or 40,000 or 50,000. So these are the problems that you are going to face if you do not manage your positions. So the first and foremost thing to manage your emotions or to control your emotions is to keep a check on your position sizing. The position sizing always needs to be very, very optimal. 1%, maximum 1.2%, not more than that. And if you're risking 5%, then make sure to not blame the markets after it you have those panic attacks or anxiety attacks in between trading, because that happens. Many people face those things. If you can handle those emotional attacks, then fine, do whatever you want. I have seen profitable traders risk more than 15% of their capital on trades. That is because they are fine with it. They know how to control their emotions. They are not emotional at all. They can control their positions like that. So if you are able to do it, fine enough. Go ahead and do it. But the fact is most people are not able to do it because we are not made to handle those kinds of stressful situations. There are just a bunch of traders all over the world who can risk a lot more than what they can afford to lose and still be fine with it. There are not many traders who can do it, and it is not advisable as well. So the first and foremost thing is to control your position sizing because that is where all the problem begins. The second thing is you have to understand that market works on one thing and one thing only, and it is emotions. Market के लिए emotion, your emotion is basically food for the market. Your emotion is basically food for the market. And if you give that food to the market, it is going to kill you. I'm not telling you market is your enemy. Market is not. You are own yourself. You are the enemy of yourself. It is just you against you the whole time. It is not a you versus the market. Your emotions are your enemy. You are your own enemy. So when you have those emotions, it is not that you cannot control your emotions. You can literally control all of those emotions with your mind. The moment you quiet your mind, the moment you say to your mind that, hey, stop, they will all stop. But you need to say that stop first. You need to have that kind of authority over your mind first. And that is why the meditation and all these yogic practices these traders follow are so popular between them. Because what meditation does is it helps you clear out your mind, it helps you clear out those unwanted thoughts, it helps you clear out the fog that is there in your mind, and it gives you a sense of authority over your mind. So meditation, that is why these professional traders are so much into that meditative stuff. They are not just doing for fun. George Soros, who made $1 billion trade, 1 billion dollar profit in one day by shorting the Bank of England, he says that without meditation it is not possible to trade. Now, such high level professional legendary traders are saying that meditation is important and a must for trading. You cannot ignore that. So first thing is to keep a check on your position sizing, and the second thing is to start meditating. It is very, very important because after meditation, you will have that sense of authority over yourself. You will have improved discipline, you will have improved patience, you will have improved clarity, thought process will be much better, and then you will be able to execute your strategies and processes into market in a much, much, much better way than what you were doing previously. So you have to understand that all these things are an important part of the market. Meditation is not just sitting in one place and just closing your eyes. It is much more than that. So keep a check on your position sizing. Learn to meditate daily, at least 10 minutes a day, twice a day. It will help you in number of ways you can't even imagine. And once you start to do that, you will literally feel that sense of authority and that control over yourself. And when you start to control yourself, you literally start to control your emotions as well. So once you start going, it is much easier, but the start is required. You is who have to start those things. Start meditating, start learning about all those things. Uh, have a check on your position sizing because that is where the emotions are coming from. If you have the position in control, if you have something that you know you can afford to lose, why are you going to panic? You're not going to panic when you know that, hey, I am fine losing 1000 rupees for today. I have risked 1000. So if it goes against me, I have no issues. You're not going to panic. You're going to panic when you have more on the table, more than you can afford to lose. So there are all these things that are going around, and you have to take care of all those things. So I hope you learned this session. I hope you understood the golden rules of trading. I hope you understood how to be consistent. I hope you understood how to control yourself and your emotions. And I hope you just learned out of this particular course because this course was designed for you to get a grip on the market. In this course, nowhere I mentioned about a strategy or in no session I shared a strategy that, hey, look at this strategy, this is going to work for you. Just replicate this strategy, and 2 years later, you will be a profitable trader. Because I do not believe in all those things. I do not believe in strategies or sharing strategies or all those things. Because even if I do share my strategies or any strategy that works in the market, it is you who have to execute all those things. And until and unless you learn that execution skill, no strategy is going to help you out. In fact, it will just hurt you more because you will keep to try trading on that particular strategy and keep losing more and more. So strategies and all those things are bullshit. It does not work until you are a profitable or a good trader. And who is a good trader? Good trader is someone who has learned the art of hiding the emotions in front of the market, who has learned the art of showing patience in front of the markets, who has learned the art of showing discipline and following his own rules in front of the market, who is shown the art of executing when the trade appears. So all of these things, when you acquire all these skills, that is where any any random strategy, even any strategy can make you money. At that point, you do not need a strategy. At that point, when you have acquired all these skills, any random strategy can make you money because it is not about strategy, it is about controlling ourselves. All right. So I hope you enjoyed this course. I hope you learned a lot from this course. And if I just hope you turn out to be a profitable trader in future because that is what I hope for. That is why I made this course to help you guys out. And even if this course helped you a little bit, I would be satisfied. I would be very happy. So thank you so much for having me. Thank you so much for giving me your time. Thank you so much for purchasing this course. It not only helps you, but also me because it also helps me as a passive source of income, and passive sources of income are never bad. They're always good. So thank you so much for giving yourself the time to learn because learning is more important than earning. Because once you learn how to get going, once you learn how stuff works, earning is just a child's play. Trust me, guys, earning is just a child's play. So thank you so much for having me. Thank you so much for your time. And If you have any doubts, you can just ping me on Telegram or Twitter. I will be there for you. I'll be there to sort your answers. I'll be there to answer your questions, whatever that is there. So I will see you there. Until then, you guys take care. Bye.